Good morning, Chris. How you doing?
What's up, man? I'm good. How are you?
I'm good. This is Brian Jones. I am here with Chris Hood, professional trader, world's most interesting man.
World's most arthritic jiu-jitsu guy, more like it. So I think that will be the misnomer. Well, the name today will be pain rules, man. I think that the sport is definitely for young people, man.
Yeah, I don't know. You can play, you can do it. You just have to be conscious, I think, of your body a little more. Like, the stuff that you did, for me anyway, I'll wake up one morning and something's hurting and it's like, I remember this thing that I did years ago. And it's like right now, injury like my knees or something crunchy.
I haven't got my brain to align with my body because I'll say stupid things to hyper athletic young people like, come on and take me, young man. Like, come and beat me up. And then they do. And then I'm like, what the hell was I thinking? That's just, got to get this to connect. It's just not connecting at the
You
moment.
got the
How are you doing?
indomitable spirit.
Yeah, let's see how it goes, man. How indomitable this spirit is, we'll see at the end of this week once the Fed tells us what their interest rates are going to be. Market seems to be waiting for a 50-point, but Fed could come out, surprise us on Wednesday and say 75, and then all of a sudden everything falls out of the bed. So got to be careful. This is not an easy market to trade. It's spitting out a lot of people at the moment.
When is the announcement again? I forgot.
Tomorrow, 2 o'clock. 2 o'clock tomorrow. I've got the calendar up here. 2 o'clock tomorrow is the statement, and then there's the press conference at 2:30. So, if you're day trading, the rule of thumb is always try not to be in any positions when they come out with that, because volatility starts to increase. Obviously, if you're trading a little longer, you've got to make tighter stops and just appreciate the volatility that comes with the event. No need to overdo the whole sit on the side and cower in the corner in a fetal position sucking your thumb. That's not going to help. It happens. We get these often. You've just got to trade around it. But the market's tough, man. There are a lot of people that are getting caught by these reversals. Yesterday's sort of short squeeze at the end of the day, where we saw that big candle around 330, took a lot of people by surprise, and it forced a lot of systems and algo buying because it was triggering stops on the short side. So, a lot of people got pushed out of positions. And I think it was just a stop run, to be honest. It didn't look like anything sustainable. We're still trading in really deep red volatility bands, which gives us the indication of trend. So, you've got to take it a little bit easy. You can't oversize things at this point, either direction. It's not worth it.
You think there's assuming that the Fed doesn't do something strange, it looks like there's a bit more downside on the.
I think so. I think it's that time of the year, it's the sell in May and go away kind of thing is still there. I mean, that type of stuff I've never really paid much attention to in terms of, it's not a setup. It's a tendency. There's a tendency of the market to be a little bit slower between now and summer, end of summer. But that doesn't mean you can't trade. I mean, I was telling you before we went and recorded, there are so many opportunities now. I've lost count. I've lost count of the opportunities. It all depends on your time frames. It all depends on what you're watching. There's always something going up at some point. Not everything gets hammered. And, how you find those, whether it's, you get them on an app or whatever, a chat group, you've just got to have a process of analyzing them to be able to see if it's a real opportunity or not, because there's a lot of rubbish. And if you trade rubbish, you're going to get rubbish results. That's pretty much what's going to happen. So, I've seen a couple of people try and call the bottom and get hammered, because this is not a market to try and bet. You can't bet that this is now the bottom. The bottom could be zero, like we don't know. And for many, many traders, they've never traded in a market like this. This is not something that people are used to, which is trading in a rising interest rate environment. It's very, very different.
So consider this a bear market? I mean, I know that like a lot of times, those all get defined.
Yeah.
Bear markets get defined after the fact. Like,
no, we're 20% down. If let me share my screen here, and this is how you would determine it, right? So it's always about percentages from the high. So I've got let's add up QQQ. So if we add QQQ, let's go to a day chart. Let me just see if this. I think it's this one. No, not that one. This one. I'll just put it on a day chart. Oh my gosh. Okay, hold on. I think it's this one. Oh no, I think it's this one. Sorry about this.
That's
Okay, no, I'll have to use this one.
it.
It's one of those days. It's one of those days.
You said you had your
Let me
coffee.
just start a new. I'll just start a new one. Hold on one second. So when you actually look at it, you've got to look at. Sorry, I'm a bit slow today. Oh, sorry. Oh my God. There it is. Okay, yeah, let's use this chart.
Okay.
Day chart. So if we look at the day chart, let me turn off some of these. Okay, let's take the day chart, go to SPY, or let's go QQQ. Okay, so if we take the high of QQQ, let's just put this back. Let's get the last year. Right, here was our high, it was 409, right? 408.85. We are more than 20% down from where that was. So we are now in a bear market. This is a bear market. It's really sort of the 20% move from the high. I think for some people it would be a 10% move from the high would give them a bear market. I think it's 10 or 20% either way. But you can see from here, this is going down. This is not a market that's going up anymore. This is definitely trending top left to bottom right. So from here, we can see, well, let's see where we are going to go. Look at that. So let's just reverse that and put it to the downside. So when we start seeing, where's the next level on QQQ, for example, it's down here. That's the next stop. If we don't hold this level, which it looks like we're going to hold. So we came in, hit the level, come up. There we go. It would be the same as going back to when was this? 2 years. That's pretty crazy stuff. So this is not an easy market, right? You don't want to be trading. You don't want to call it bottom. This is the dangerous part. Is we go, okay, no, it has to stay, and then you load up on calls, and then this just goes zoop, like that, straight down. So I wouldn't be loading up on calls anywhere underneath the 21 and the 34. I really want to be above 338. And I could start building something here. You can see I've got this orange dotted line here on QQQ, and that would be my early long trigger. That would be, okay, something's going to start happening. I would come down here, look at my squeezes and my stochastics, and I'd see, okay, is there something bullish that's being set up here? Maybe we can swing a trade. But honestly, you've got 3 levels you need to watch: 351, 340, and 327. Those are your 3. You could add positions at those 3 levels on the way back up. But calling a bottom now, no. Your safest bet is to trade to the downside. So the easy money will be to the downside for now. And it's the same thing with SPY, right? So when we look at
picking
SPY,
up long-term holds, this would be a good time to accumulate a few on the way down, or no?
the problem that comes in is maybe it's going to be cheaper next week. What you could do is you could sell a cash secured put, right? You could say, okay, I really want to buy Apple. Okay, so the way to play this one would be, I want to buy Apple. Apple's trading at 157. Anything down here, 150, this would be a great price to buy Apple if it gets here, right? So right now we have a 1321 bearish cross, a divergent low, and we have a candlestick reversal that's saying, you know what, we've got 3 conditions here that are telling us the price will go up. We've also got increased volatility. Our stochastic is near oversold, and our squeeze is tilted to the downside. So you've got this mixed bag. It's like a 50-50 looking at Apple right now. Could Apple come back down here and test 150? Yes, it could. What you could do is this. You could say, I want to buy 300 shares of Apple. I could buy 100 here and sell 2 put contracts at 150 and get paid the premium that if it does come down to 150, I'm going to buy them for 150, and I got paid to wait. That would be the safer way to play it. If you said, oh, you know what I'm going to do? I'm going to buy, 400 here, and then all of a sudden this drops to 150 and it falls further. your stop line that you would have on this would be probably around 147. Once it hits 147, you've now taken a loss. Your 150s would have been assigned to you. It just makes more sense to sort of say, look, I can buy them cheaper probably. So maybe buying 100 here, selling the 150 cash put, let the price rise. The premium from there is income for you. So your net purchase price here would be, let's say, on $2 premium, 148. You could buy your second 100 at 161. That would give you an average price of 154, 155, and so on. You just build it going up. But don't average down. I'm not a fan of averaging down, because if you average down in a downward trend, you're just throwing good money after a bad idea. And then, you average down, and before you know it, you're stuck. You can't get out of that trade. So that's the way I would play it. I think Apple's a decent one to look at. Tesla's a good one to look at. Microsoft, all these companies that are not going to be, killed by a small interest rate rise. Those are the ones that you want to be looking for. So Tesla, Microsoft, Apple, Google, Amazon even, those ones would be good buys. Yeah, you could certainly look at that, but do it smart. Don't just throw your money into it. Rather, pick them up at good price levels.
So
are you still there?
Yeah. There's just
Oh,
there's some
sorry.
lag. There's some lag on my end for some reason. So can you hear me?
Sorry, did you get everything? Because I was just warbling, and then you were just staring at the screen.
Yeah. I got
What's going on?
I got everything. It's just it said that your connection is unstable or whatever.
Okay,
I'm sure the recording's fine.
cool.
You're the only you were talking. I was just staring anyway. I
thought I looked at you staring, and I was like, "What the? Has Brian been possessed by an alien?" That's the thing that I was looking
I
at.
do that. I just go completely motionless. To get into mannequin mode. So what? Let me think here. So let's talk a little bit about that interest rates and so what if the interest rates are a little higher? What do you expect from the market? What does that typically?
Well, the thing that you've got to, the hardest part for any type of trade scenario is understanding what the market may or may not have priced into where it is. Okay. So it comes down to this expectation kind of thing. So what does the market expect? The market expects a 50 basis point rise. So as soon as they expect that, the market then prices everything for that, right? If Powell comes out and he says 75 basis points and the market hadn't anticipated that, we're going to see some pretty big selling. If he came out and said 25 basis points, we're going to see some pretty good buying. And if he says 50, well, we've already priced it in. We shouldn't expect too much. Maybe there are some, market participants that are sitting there going, well, if he does do 50, we're going to buy, because it says, that's pretty much
confirming the pricing.
Yeah, and then they will go in and buy. And then there's some people that say, if he does 50, we're going to sell because we were hoping for 25. So the way to keep this in mind is I just watch this TNX, right? So TNX is the 10-year yield. This is what's affecting the tech stocks right now. As long as this is in a green volatility band, moving to the upside, tech stocks will struggle. That's how it is. So, we can look at this on a shorter time frame. And you can see, the Fibonacci doesn't make much sense here. Let me just take that off. So it's in a green volatility band. So as long as it's in a green volatility band, here's the green, tech stocks are struggling. And it's going to rise. This is going to continue to rise. So
that's that's the index, correct?
This is the TNX. This is the yield. This is the actual yield, the 10-year interest rate.
Is there an ETF on that, or?
Yeah, there is actually. Hold on one second. I will find it. I don't trade the ETF on this. I don't trade it that much. Give me a second and I'll find it for you. Here it comes. So TYD, here we go, IEF. So IEF is the 10-year the 10-year yield, this is the 10-year bond, right? So what happens is rates go up and these bonds will lose value, right? So what you want to be looking for is you want to be trading TYO. So TYO goes up when interest rates, or goes up when bonds go down, right? So this is the 10-year bear stock for the treasury rate or treasury bonds. So this is the one that you want to trade. If you want to trade that yield curve going up, the 10-year rate going up, this is the bond, this is the ETF that you would want to buy.
TWO, you said?
TYO.
TYO, sorry.
Yeah. So right now, you know, it's gappy. You can see these gaps that are forming. This is the 195-minute chart. Let's look at the daily. That looks pretty good for a trade, if you ask me. I'm going to have a look and see if there's anything that we can do on this one. So let's see. It's not a very liquid option chain. Not a lot of volume goes through. There's quite a few open contracts. Look, you're not going to get a huge move out of this. Yeah, its beta is very, very low. So you're not going to get a huge move. Sometimes it might be just better to buy the stock. You know, maybe do a married put on it, because at some point interest rates will come down. And when interest rates come down, this is going to move 3 times faster, right? So you want to take that into account. But this is a reasonably, I think this would be a good play for those interest rates. So I'm actually going to write it down. I might do something on it today. Yeah, so it's an interesting market. There are a lot of opportunities. It's just how you view them and how you assess them that's really going to make the difference. You know, we can play around with a couple of things here. Give me a second. So here, the way that I like to look at stocks, and you know, is here on a slightly lower time frame than a day. So here I use the 130-minute. This one basically gives me 3 signals per day. So at 9:30, 11:40, and 1:50, those are the times that I get my signals. So I know that 3 times a day I'm going to be given trades on that chart. This is my main chart. And what I like to do is build my squeezes on different lengths. So some people use different time frames. They look at the squeeze on the 5-minute, the 10-minute, the 15, the 20. I try and use the same time frame, but I shorten the squeeze. And then from that that shortened squeeze, I can get signals. I can see if my 10 squeeze is going to move, well, obviously it will move faster than my 15 and my 20. It will give me a sort of sense of direction when I merge this with my stochastics, right? So if my shorter duration squeeze stochastic is red, and that's yellow, and that's yellow, it's inevitable that this will go red, then that will go red. So as soon as you start linking everything up, it becomes a little easier to spot where trends reverse. So the 130-minute works well. Then I use the 33 and the 65s for timing. So you can see the accuracy of these signals when they started to come in yesterday. And then I use the daily and the weekly if I'm holding the positions overnight. So you'll notice the daily is actually a 375-minute chart. It's not a 390-minute. So I try and get my signal before the market closes. There's one signal at the beginning of the day, one signal at the end of the day. So I try and see those two align. When they align, I trade in that direction. So if I'm holding overnight, I want to always hold overnight for the day signal or the 375-minute chart for the next day.
Because so the 375-minute chart is essentially like the day chart, but it gives you a 15-minute.
It gives you that break at 9:30. It gives you a candle, and it gives you a candle at 3:45.
Nice, nice.
So just before the end of the day, so that you don't get trapped. Like you don't want to get trapped in a trade that you hold overnight, then you get kicked the next morning. Like you don't want that. So this is a really useful setup for me. And then the weekly chart is a really important one, just to understand the movement. If I'm holding a leap, if I'm holding a 6-month or longer contract, this is the one that I will use to monitor that position. So, you know, as far as it goes, if you've got all these volatility bands in the same color, you'll see red, 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 red. Very, very little to be bullish about when you've got that situation. So, and this works with any stock, any trade. You know, here we could look at Johnson & Johnson. We started a short position on Johnson & Johnson a couple of days ago. Here, when the volatility band started to shift to red, you can see that we got that short trigger. We actually went in on that yellow bar there. You can see the squeezes all firing to the short side and the market opening down at 177 this morning. So this one will end up being a pretty easy trade. And it's very much around aim for where these volatility bands are shifting color, because as soon as they start shifting color and you get alignment across the intraday, 1, 2, 3, and now we get the daily in line, that's a trade that's going to last a couple of days. So that's how we do it. It's, you know, we try and make it pretty simple.
Question here. When you trade short, do you take profits earlier?
Yes, I have a much tighter tolerance for volatility. So I don't use the standard settings that you would have, you know, on your ATR trailing stop, for example. You wouldn't use the same that you would on a long trade. Remember the speed of a short trade, right? So the speed of a short trade is it's faster. You are going to materialize gains much quicker. The thing is, a lot of people apply the same rules short, long, and that's what makes the short trades often take out a lot of the long trade profits, because it reverses out and then you know, why did I do that trade in the first place? So you do have to be slightly more conscious of the trades. You can't just leave them. And you've got to do your trailing stop. So you can see this little dotted line here. Every day at the market open, we just drag it down to below the next level of support, and we just bring it down, constantly chasing the trade to the downside. So if it does reverse and cross the line, we can exit quickly and take profits. So you are going to be a lot less tolerant.
So with your volatility bands, do you do like what's, you know, put it to ATR, you do something, what is it?
I use it like a 1.8, maybe a 1.5, depends on the stock. You know, if the stock is a high beta stock, you really don't want to be kicked in and out of a trade. So you've also got to bear that in mind as well. The thing with trading on different time frames is the up, down, the mincemeat that gets caused by in and out. You know, if you look at SPY yesterday afternoon, there were some interesting candles that formed towards the end of the day, right? That little reversal here, this was definitely a short, you know, a short covering rally that we had here. Market's going to open up again, and that's fine, because if we look at our indicators, we know that that's going to happen today. That was printing a divergent high bar, a divergent low. You see how it closed yesterday on a purple bar? Now it's going to open here. We still don't have an exit signal for our bearish put spreads. All right, we're still in our bearish put spreads because we've got that short trigger triggering here. So we're trading that signal to the downside. We're trading this candle to the upside. So we've actually got two positions on. One's trading one setup, one's trading another setup. So we don't trade only in one direction. We try and make sure that we can trade in all of them. And look here, we've got short, 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 short with a MA cross as well. And we're also in a red vol band that's broken to the downside. So I'm not so sure this is going to last that long. With squeezes that look like this, we do have these minor buy signals here. This squeeze is already refired to the short side. It's got a lot of work. I mean, it really needs to, the bulls need to come in this morning and push this way. If it can close above 431, I mean, expecting a 16-point rise in the SPY today before the Fed, I don't know if that's going to happen. That would require some significant magician work. So yeah, I think that this might just be one of those pops at the open and then a retrace back and then just chop around. We're in a washing machine at the moment. It's just really difficult to call a direction. So what we try and do is we have a small position that trades the signal. We have a small position that trades that signal trading to the downside. We have a small position that trades this to the upside. We are more than happy to close this one when we get a signal, a divergent low, high bar. So when this prints an orange candle, we will exit and we'll continue to hold that one. That's got a much longer duration on it to the downside. That's pretty much what we see, right? And the bulk of our trades are to the downside. You know, we're shorting Mondelez. Here you'll see it. We've got a red volatility band on a divergent high. We had a short trigger yesterday with a squeeze firing short on three lanes. There's short, close of the long. There's no long entry here, and a red volatility band starting to form. So we've got alignment, a decent degree of alignment. We've also got a short position on Duke Energy. It's going to be a nice pop this morning though to the up to the upside, but there's the short signal trading this to the downside. Squeeze is still firing, so we should anticipate this. There's an MA cross on the 33, short signal, almost breaching the bottom of that vol range for the weekly. We've also got a short position on, we got a long position on PSQ, which is the short Qs. So here it's going to open a little lower, but we're trading this green volatility band, and we don't get put off by one candle. You know, it's very important not to get thrown out of your position by one candle. We trade the volatility band. It's green, 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 green. You stay long. You don't go short just because there's one big wicking candle. You know, you have to imagine that this is going to come down, and it's going to go back up, and then it's going to cross here, and then it's going to go up there. Facebook is the only bullish trade that we have. Facebook and Moderna, we have two trades here. Facebook on earnings, we got these long triggers, bit of chop, divergent low bar, squeeze firing north on all three of the lengths. Here it's going to breach that gray zone. Hopefully we can get to that line there. Once that's there, that's a very bullish move then from Facebook. We can add to the trade here on the 375. It's going to open up here. We're looking for it to get to there and then up to there off that long trigger. So we've got long, 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 sufficient for us to trade this one. So Facebook's a long trade. XLC, we are short XLC. But with Facebook doing so well, we have to remember that this is probably going to, this could trigger an exit here. This one here looks like it's going to head towards that 62 level, but still trading in this deep volatility band that's red on both the daily and the weekly. So at the moment, not much bullish stuff. You know, there isn't a lot of stuff that you can be extremely excited about. I'm looking down here to see if there's anything else that possibly looks interesting. This one had a big day yesterday. It's got, you see how the volatility band is shifting to green?
Yeah.
And you've got your squeezes that have all fired to the upside. We're down here at the top of this line. We're looking for a move to 380. You can see on the 33-minute up at the top right.
What is the ticker?
MVIS. So this one, what happens is our clients get our watch list 3 times a week. I will do a new watch list 3 times a week. And a lot of the trades that clients take come from the watch list because the signals are all pre-programmed based on the settings that you want to trade. So, you know, there are multiple ways of using the watch list, but MVIS and BBIG were from yesterday. Yeah, you can see the volatility band just about a break, squeeze north, 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 long, long, close the short. We did have this MA tool, a 1321 cross here on the 375, but we got to watch this one a little bit carefully. But this weekly chart, look at that. You see these green candles. If we can get a break above 354, there's no resistance here. We have no zones pushing it back. So that's what we're really looking for, is a break above that 354 level. So, you know, we've started to build a position there in the intention that it's going to pop above this 270. And then, you know, the next level of resistance is here on the 130-minute chart. So this could take us up to 350. We need that 350 to break that vol band to the upside. So really a trigger here at 270 would probably be useful as well. Add to the trade. And that's how we do it. We literally look at our levels, we look at our colors, we align colors with levels, place our alerts and wait. If it comes, you know, we'll act on it when it happens, but we're not going to force a trade. Like a lot of people will force trades into their into like the main trades. So this is our main trade list. So this is the go-to list. If you can't find anything in the watch list, we always go here. You know, some people will look at a trade like Nvidia, for example, and you know, Nvidia is a really strong performer in the semiconductor space, but you can't force a trade here. There's no trade to force until Nvidia gets above that 213 level. It's a very, very difficult trade to do because you've got short signals everywhere. So could I trade this? No, because it's in the middle of my band. It can go either way here. It can go that way or it can go that way. So if I don't have a clear direction in terms of which way it's heading, I'm not going to trade it. It's just, there's easier trades to do, and you're better off looking somewhere else. But yeah, that's about it. I would say to people, be careful. Trade a setup, don't trade an opinion. That's a big piece of advice. Please put it there on a piece of paper next to your computer. Trade the setup, don't trade your opinion. Just because you like trading bullish doesn't mean that the trade has to be bullish. The trade will do what it's going to do. The market will not really give a crap about you. So, try not to think that the market cares.
Right. Sounds good. Good advice. Hey guys, go over and check out Chris's product at rogueinvesting.com/alpha and get in on this. Get the tool, get the trades. And Chris, I'll hope you feel better, man. I'll talk to you next week.
Thank you. You too, buddy. Take it easy, and we'll chat next week.
Yep. See ya.
Cheers. Bye.